Ready? Linda, fire up, please. Really good job here by our guys this morning on a research team putting together some. I don't like to call anything we do basic, but it's very important to hammer home, especially because there's so many new listeners, to hammer home a lot of the stuff that we talk about all the time and to make it very real.
Kind of sprinkle the infield with some review. Yes, I got it.
Well, one of the things we're focusing on now, Tony, is we are focusing on adding a little bit more, a few more stories into the mix of just information. So they're not rants or whatever else. They're just stories, analysis, analogies, just lots of different kind of complementary amounts of information, as much as we can pile on to support just everything we talk about strategically. We're often asked what criteria we use for an underlying selection. While it is more of an art than a science, there are a few common themes to be aware of as we develop, or as you develop, your own selection strategy. One of the things that we had to do as a individual retail investor was start to develop, Tony, we had to come up with a whole new universe of trading after we left being a member of an exchange. As an exchange member, what most people don't realize is, even though you're an exchange member, you don't really, it's almost like being a reporter. You're not a reporter for Major League Baseball. If you're a baseball reporter, you're rarely a reporter for Major League Baseball. You're really a reporter for your team.
Correct.
You know, most people are beat reporters, or they are locked down with one team. So they get to know all the ins and outs because that's what's valuable. Traders, the same thing. You're not a trader. If you get hired by a firm to be a trader, they don't say, hey, you know what? Here's a couple $1 million. Why don't you just use your brain and come up with some ideas and put the money to work? That's not how it works. Okay, that would be insane. Usually what they say is, hey, here's a stock. And you know what? You better become damn good at this stock, and or here's a few stocks. And learn everything there is to know about the way these stocks trade, about the liquidity, about the open interest, about the volatility, about pricing, about all the theoreticals and all the Greeks and everything you have to know about this, and this is what you're going to trade. And you're like, okay, that's cool. When I first got out of college, there wasn't a lot of derivatives trading, so a lot of my friends got jobs as not really specialists, but as market makers, as over-the-counter market makers and specialists for different firms on Wall Street, because a lot of us had finance majors, and Wall Street at the time was hiring, and so they became market makers in over-the-counter stocks. And you don't get like 100 stocks, you get like, I don't know, 3, 4.
Right.
That's it. Okay, let's go next slide. Maintain a list of 30 to 50 liquid products. We're just getting back to the basics, and then we'll get a little more intense in a few minutes. Maintain a list of 30 to 50 liquid stocks. Build your sense of market awareness by monitoring these products from your list. From this list, a large majority of our trades and assumptions are made. Here's the craziest thing. Outside of earning plays, 98% of our trades come from our watch list.
Correct.
You come in here and you call in and you talk about a stock that we've never heard about before, and there's a 1 in 100 or 2 in 100 chance that we're going to do something with it. And occasionally I will. I even talk about it on the show.
Well, we do it sometimes right then when we're talking to people.
But for the most part, you talk about something, we go, I don't really trade that stock. I've never heard of that stock. If it's on our, quote, our liquid list, futures and or option stocks, whatever it is, outside of earnings plays, we're all over it. That's it. We stick to the things we know the best. We feel the most comfortable adding to those positions. Let's go next slide. When considering an underlying to trade, we look at a few key statistics. We look at implied volatility. We look at implied volatility range. We look at liquidity. We look at binary events. We look at price strength we look at price weakness or strength. But we also must consider our existing portfolio as well as overall market conditions. Now, I got to the retail business in 1999, 2000, when we built Thinkorswim. And for the first time, I was introduced to people looking at a stock without looking at the market. I got very confused. TP and I used to sit down and go, how can you look at this stock without knowing what the market's doing?
Can't.
Worse, how can you look at the stock without knowing what the futures are doing? And then even worse, where's my portfolio? How can I look at this stock, look at my positions, and try to determine what to do without knowing what's in my portfolio and what the market's doing? This is not a one-off business. Nobody makes money being one-off. Now, this will explain why, and I'm going to save this piece for tomorrow, but we're going to do a really fun study on, hey, you know what? Everybody comes on and says, if you just buy and hold, if you just believe in this, these are your return. It doesn't work that way.
Right.
I'm going to show it to you tomorrow. Right now, you have to consider your existing portfolio, because what if you're short 10 different things?
And
You don't
you've
need to.
Right. You don't need another one, or you've got a positive in something else. You got to keep that one on. It kind of offsets the whole portfolio.
Of course. Listen, I hate some of these stocks. I despise Yahoo here. All right. All I want to do is sell that stock. But you know what? I'm already too short everywhere else.
Correct.
To sell Yahoo. It's not worth it for me.
I answer people that way when they send me emails. Sometimes they'll say, hey, look at this stock, ABC. You know, it's got a high volatility. It looks at the higher end of the range. I think it's a great candidate for doing a vertical spread. I says, you know what? It does, but I'm already short the market. I'm
That's
okay.
right. That's right. I'm full. This is a
Right.
beautiful, what do you like, cannolis? This is a beautiful cannoli. Sviadel. This is a beautiful Sviadel.
Thank you.
Okay. But I just had two desserts. And then you're like, okay.
Didn't stop you yesterday. You were still eating my birthday cake yesterday.
It's pretty good.
I know.
Let's go to the next slide.
Tinkles is a winner.
It was really good. Implied volatility. Implied volatility is a very important statistic in our underlying selection as well. Implied volatility tells us the expected move, and it's a key factor in the pricing of options. In our selection process, we look to compare implied volatility to the overall market and to correlated products. Listen, I don't care if you know what implied volatility is. If you don't, I mean, obviously the more you know, the better off you are. But it is very valuable to be able to put context around your decision making. If you're about to buy IBM here at 200, where's IBM right now?
IBM is trading for
$199.85. So if you're about to go out and buy IBM at $200,
it did trade as high as almost 201, 294.
If you're about to buy the stock at $200, it would be really nice to know before you tell your friend, I'm buying IBM at 200 because I think it's going to 220. It'd be really nice, or I'm buying IBM at 200 because I read this Goldman report said it's going to 230. It'd be very nice to know, hey, you know what? I'm buying IBM at 200 because the statistical chance of it trading at 205 is 48% or 98%. Actually, it's probably about 35% chance it trades at 205. I'm just guessing, and that means there's a 70% chance it touches.
Right.
Okay, and that's just taking some just ballpark numbers. That's a cool thing. It's really nice to sit down at a blackjack table and I talk about this all the time when I'm doing seminars. It's really cool to have random strangers tell you what the exact odds are of winning the hand in blackjack. Random drunk strangers who you don't know, who have an IQ of less than 90, okay? And they're telling you what the statistical chances of you winning this hand based on your card. And yet nobody in the world can tell you what IBM is going from 200 to 205 realistically, probability of a touch in the next, 35 days.
Right.
Okay, 100 days, whatever it is. Come on, let's get our act together. Next slide. The IV range is a look at the current IV implied volatility relative to its high and low over a period of time. What's a reasonable period of time? We say probably, a year.
Right.
And we look at the underlyings that are trading high in their IV range to possibly play for an IV mean reversion. Again, this is a discussion today on selecting underlyings. So the reason we look at the IV range is we're always thinking mean reversion. You're going to hear mean reversion a lot more. You're going to hear mean reversion when it comes to I heard the term mean reversion yesterday or the day before when somebody was talking about athletes who are playing for their contracts in a contract year. So this year, for example, in Chicago, Jay Cutler, who's the quarterback of the Bears, is in a contract year. And the discussion was, is Jay Cutler going to have a great year so he gets a new contract and then next year revert to the mean? And I loved that because that's what we do. How can they have that conversation on sports radio? We can't have that conversation with implied volatility. Right. That's the future, man. Let's go next slide. We look to liquid products as these will offer us the most efficiently priced options. And again, this is a hard thing for a lot of people to recognize. Our listeners are really smart about this. If something has a one penny wide market, it has to be better for you long run if you can find something to do in there than something that has a wider market.
Listen, we've shown you on the market measures, past market measures, how much that affects your return at the end of 1 year. It's just common sense.
I bought a couple years ago. I bought a car.
It's tens of thousands of dollars.
A couple years ago, I bought a car for my son. It was a Jeep
Liberty.
Liberty. And what I didn't know at the time was the market on the Jeep Liberty was down to like $50 wide. In other words, he looked at like 3 or 4 Jeep Liberties, and every car was within $50 to $100 of each other.
It's efficient market.
Yeah, it's a used Jeep Liberty. It was like whatever it was, $12,000. Let's just say, and the market at one place was like 11.9, and these are individual owners too, to 12.2. So there was a $300 wide market on 4 or 5 different Jeep Liberties. That's an incredibly efficient market. So at the time, I was like, just pick whichever one you want. It doesn't make a difference to me.
Right.
Okay, because whatever, they're all the
6
same.
of one, half dozen of another.
When you bought your Lambo, right?
This is what happens when you make a point scalp in 2 minutes on some Tesla calls. This is gonna be.
I'll be fair. When you bought your scooter, that little scooter, okay. Yeah.
Tony from Mexico got that for me.
Oh, Tony did. Okay. There is.
Go ahead.
When you buy a more expensive car, okay, then obviously the market's much wider. So you buy like a $70,000 car or a $60,000 car. Of course, you go to resell it. All of a sudden, one person is offering you $30,000, the other person offering you $40,000.
G's wise.
The market's $5,000 wide.
Right.
So like I was trying to, at the time, teach my son a lesson. Like, hey, this is an efficient market. He goes, I don't care about the efficient market. I want the red one. Okay, I'm like, dude, you got to figure this stuff out. And he's like, I don't care about the efficient market. Stop telling me about the efficient market. I want this one because it has blah blah blah.
And then he turned to his girlfriend and said, "It's right. I do want the red one, right?"
Shut up. You are a jerk. Anyway, so
I mean blue, Dad. I mean blue. Sorry. Hey, I pick on the daughter. I got to pick on the son. I might as well have the whole family hate me.
You're gonna have to.
Wife is off limits though.
You're gonna have to deal with Mama Bear.
Not good.
Not good. She's gonna cut you. Anyway, that's the beautiful thing about liquidity.
Jeff, our intern, just IM me and said I'm up money in Walter from being down a couple $100. Now he's up a couple $100.
Wow, look at that kid.
Yeah,
he is getting it totally. It's so funny because I go,
Big number for him too. That's awesome.
I go, I've already talked to him about this. I go, I've completely ruined business school for him.
I know, it's so funny though. He sold a naked put in Walter, and he has a very, a smaller size account, really tasty bite size account.
Like 2 million, right?
yeah. This is the kid from goes out to the Hamptons. I said, listen, do yourself a favor. I said, buy that put, and you're reducing, the put below, and you're reducing the amount of capital you're using by about 45%. Then take that capital that you just saved and apply it someplace else. You'll be able to hold that position a lot longer. And he's saying that was really one of the keys. So that's awesome. Good for him. Proud of him.
What do you want, a medal?
No, just for listening and using his money. Sometimes you have to do things because of the account you have, whether it be a naked option because you have a larger size account or using a spread. You just have to do different things.
Linda, we're going to try to get him sainted this weekend.
Kill him. This is.
We'll start the paperwork.
Please start the paperwork.
Please start the paperwork. We're just.
But that obviously doesn't watch the show because I nail your nose every time.
We're just going to start the paperwork for sainthood. Okay, that's all.
That's something I will not win.
Let me think. I just went through this. Yes. The following chart shows a variety of underlyings, 2 of which do not trade due to a lack of liquidity. The key elements to look for are volume and open interest on illiquid products. Let's go to the next slide, please. And what you can see here is, and we tried to add a little color to it so it can pop up, are Tesla, GDX, CLF, and Cisco. And what you can look at is the open interest on the at-the-money call in Tesla, 3,000, GDX, 6,000, CLF, 13,000, and Cisco, 49,000. Now take it down just to the bottom, and there's 2 stocks, Fossil and RL. And Fossil has an open interest of 535, and RL has a open interest of 130. And the reason we're showing you this is because we just want to put into perspective some of the things that we're talking about.
Yeah, look at how wide the markets are. 20 cents wide in Fossil. They're 30 cents wide in Ralph Lauren. The other ones are penny wide markets. You get a lot more open interest.
When you look at the relationship between implied volatility, IV percentile, and again, all this is archived, but the relationship between implied volatility percentile, open interest, and the bid and ask, and you start to recognize here exactly what we're talking about. GDX 126, 127, CLF 101, 104, Cisco 71, 73, And when you look at the IV percentile there, the IV percentile is actually higher. The IVs are higher, and yet at the same time, the pricing is much tighter.
Correct.
And that makes for a more efficient trader.
Now you look at Tesla; it's a $120 stock and has a 25-cent wide market, with the open interest being a little over 3,000 in those calls. You put a trade in, or a bid, or an offer, a standing offer, or even a vertical spread at the mid price. The stock moves 4, 5, 6, 8 cents one way or the other, and you get filled. Where you do it in Fossil or Ralph Lauren, you're not going to be able to get filled because there's just not enough liquidity.
Let's go to the next slide. Earnings binary events. We use earning announcements and binary events for trading potential. These events have significant impact on implied volatility and theta decay. Being aware of these events can and their effect on option pricing is critical to our selection process, because as you see with Tony and I, we are very careful to exclude, Tony, certain events. In other words, if too many of our stocks have earnings, we don't play as many earning stocks. If too many of our stocks are involved in some kind of, quote, an event situation, we try to migrate off of that to something else. Yesterday, we traded GLD because we didn't want to deal with any more earning stocks that have upcoming earnings this week or next week.
Yep.
And in the afternoon, we're very careful to make sure that we're down to maybe 1 or 2 earnings plays, and that's it.
Yep.
Next slide, please. As contrarians, we buy into weakness and we sell into strength. We look for the price action of the underlying to assist us in our selection process. And it's not just price strength and price weakness, it's also volatility strength and volatility weakness. If we are buying stuff in, one of the reasons we're premium sellers. We like to buy into strength because volatility contracts into strength. We like to sell into weakness because volatility expands into weakness. It's not just about price, it's also about volatility, contraction, and expansion. And then finally, last slide. In our underlying selection process, we look for highly liquid, familiar stocks. We turn to absolute IV and IV percentile for potential trades governed by high POP, probability of profit, and plausible ROC or ROC, return on capital. Ultimately, trades are triggered by our assumptions, be they directional, IV, or otherwise, which means we are not non-directional. It's a big key takeaway from this. We are very opinionated. We are very directional. And again, so we're not suggesting that the world lives in this non-directional delta neutral. It's all governed by neutrality. That's not it at all.
Correct.
We're engaged. We have opinions. You saw that in IBM. You saw that in Intel. We don't mess with that stuff. We just assume over time everything plays out.
Very good, sir.
Good stuff. We take a short break. We've got Jacob in the house. We're going to do the skinny and options math coming up next.